Mm-hmm.
Okay, so we are defining financial management where, okay, before definition, we said the owners of the business transfer resources to managers or accountants. So, as an accountant, you are entrusted with the duty to manage those resources. So, we can say financial management is a process where we manage finances of an organization so that we achieve an organization's objectives. Organization objectives can be profitability, can be to increase dividend payment, for instance. So the aim of financial management has to ensure that all resources are obtained and they are used efficiently. So efficiency actually means we should be able to get the results that we need with the little resources that we have. Okay. So to understand financial management better, we should appreciate two concepts of financial planning and financial control. What is financial planning? So in financial planning, what we do is we forecast future financial needs. So what do we need in the future? In the future, we might need to hire new employees. We might need to extend our business. That's financial planning. So in the process of financial planning, we have to ensure that there is availability of funds for investment as well as operations. For example, we can prepare a cash budget now so that we prevent liquidity problems in the future. If you have a cash budget, you know how much funds you spend and you can prevent challenges which might occur in the future. So once we have made the financial planning, we should now be able to control the resources. So financial control shall involve the monitoring and controlling our financial resources. So the financial resources that we have to monitor them. Are we overspending or not? And we should also control them. Now, to control such financial resources, we might need tools such as budgets. So that's why we prepare budgets. We might need variance analysis to see whether we are in a favorable or adverse position, and we might need ratio analysis. So financial control is important because it will help us to align actual performance with plans or budgets. So that's the first introduction. If you have a question, can you ask?
No, so far no.
Alright. So what are the objectives of financial management? The main objective of financial management, or the primary, is to maximize shareholders' wealth, because we are managing the finances of shareholders. So our goal is to maximize their wealth. Now, shareholders' wealth is measured by two things. One, increase in share price, which is known as capital gains. Two, dividends payment. So those are the objectives. Now, this objective is always long-term focus. It cannot be achieved at once. It can be achieved maybe in 5 years. Though it's long-term focused, but it's the main objective of financial management. So if you look at the share price increase, let's say from 50 kwacha to 100 kwacha, and to be able to pay dividends to these owners. Okay. So how do you calculate shareholders' wealth or shareholders' return? The shareholders' wealth is calculated as P1 minus P0 plus D1 over P0 times 100. Okay, so in financial management, very few formulas are given. Majority we have to memorize. This one is not given, but it's a simple formula because P1 means share price at the period end. So how much was the share price at the end of the year? P0 is share price at the period start, and D1 is how much dividends that has been paid. Remember, the component of shareholders' return is share price and dividends. Okay, let's demonstrate that simple example. Annex Limited has a share price of $4 on 1 August 2025, so that is P0. The company paid dividends of 5.8 per share during the year, that's D1. On 20th August 2025, the share price rose to $17, that is P1. So required, I get shareholders return. So I'll say shareholders return is 17, which is P1, minus 14, which is P0, plus dividends 5.8. So if you do that, the answer will be 8.8. Then you divide by P0, your original share price, which was 14, times 100, you get 62.86%, or you can say 62.86 cents. So it means shareholders' worth has increased by 62.86 cents, or 62.86%. Do you have a question on shareholders' worth?
No, I have understood.
Okay. So I've said the primary objective is to maximize shareholders' worth, which comes from dividends and shares or capital gains. So what are the other objectives? So the secondary objectives include survival, for which we ensure that our company is going to survive. So going percent. Growth, our company should grow, maybe in terms of sales, sometimes in terms of number of customers, sometimes in terms of number of employees. Then profitability. So we should increase profitability, maybe increasing profitability by 10%. Then social responsibility. So we should be able to take care of the needs of the society, maybe sponsoring activities, helping orphanage, and so on. And also reputation. We should have a good reputation as a company. So those are the secondary objectives. Now the objectives in financial management can be grouped into financial and non-financial objectives. Financial objectives include profit, so liquidity. So liquidity actually means being able to finance your short-term needs. Return on investments, these are ratios we'll look at later. Profit retention, so after we pay dividends, how much profit is remaining? Restriction on gearing levels, so how much gearing should we have, or how much percentage of debt should we have? Then we have non-financial objectives, which include customer satisfaction, the customer should be happy, employee welfare, ensure that the welfare of our employees is met, sustainability, we should ensure that our actions are for the betterment of the future, welfare of society, as well as speed of delivery. We should deliver the products as quickly as possible. We can also add on quality. Okay, do you have a question on what we have covered on the financial and non-financial objectives? Hello? Hello?
Hello?
Okay.
Hello?
I was not getting you. Okay.
Okay.
Then let's now go to financial management decisions. So as a finance manager, there are 3 decisions that you make. So you make investment decisions, financing decisions, and dividend decisions. Some books can say even working capital decisions. So what is an investment decision? An investment decision involves capital allocation into projects. So if you have got projects, how are you going to allocate them? Example, maybe let's buy any machinery, let's extend the factory building, or let's undertake marketing or advertising campaigns. Or the second decision can be financing. Financing is about where do you get money to run your business. So you can make a choice of debt, maybe you should borrow, or equity. So equity, maybe you can use shares, or maybe you can try to borrow. Now, examples could be issuing shares, obtaining a bank loan, or sometimes sell assets. Dividends. So dividends, remember we said this is the key objective of financial management. So in dividends, we are trying to look at how much profits should we distribute to shareholders. So examples, we can go for retained earnings for growth. So for example, we can say instead of paying 20% of profits as dividend, let's pay only 2%, so that the remaining money we should invest. Or sometimes we can decide to pay cash dividends. So the other decision can be working capital. Of course, it's not explained in these books, but other books say working capital, where you have to manage your day-to-day financial operations. And we can also talk about risk management decisions, but not this will be covered later. But those are the main decisions in financial management. Okay. Then now let's appreciate corporate strategy and business objectives. So what is a strategy? So a strategy is a course of action to achieve an objective. So what should you do so that you achieve the objective? If you want to be profitable, what should you do to achieve profitability? That's a strategy. So strategy is divided into 3 levels. We have corporate, business, and functional. A corporate strategy looks at the whole business that we are in. So what industries, for example, should we be in? Or what should we do to have more employees, or to have more customers? That's corporate strategy at a higher level. Then business strategy, we are now talking about how should we compete? How should we be better than our colleagues? Then functional strategy, we look at how can we meet specific department objectives. For example, in the sales department, how should we achieve sales? Which type of people should we employ in the sales department? So that's the functional strategy. Now, the challenge that we have in organization is to align our strategy with financial goals. So how do we achieve it? So we should ensure that when our strategy is providing direction, at the same time, we should have finance measures which should improve our performance. So when our strategy is providing direction, at the same time, we should ensure that we come up with financial measures which improve performance. For example, we can say a growth strategy must be supported by financing decisions. If we want to grow, let's say we want to expand our factory building, then we can look at the finance strategy. A good finance strategy would be we should maybe borrow a loan to expand the factory. That's what we mean by aligning corporate strategy and financial goals. Okay, so the important component in financial management is stakeholders, because if we don't manage stakeholders, we are not going to achieve our objective. So who are stakeholders? So stakeholders are defined as individuals or companies who are interested in the financial affairs of the business. So we should appreciate this type of